In this video, I'm going to walk you through a fairly detailed numerical example on how you can go about estimating an investment's cash flows. Recall that any investment's cash flows can be calculated using this particular equation. It's financial cash flows equaling operating cash flow, net of capital expenditure, and changes in net working capital. In a previous video, I've explained the intuition and the significance of this equation when estimating cash flows. And in another video, I've also talked about how you should always think about evaluating an investment based on its incremental cash flows. And so the purpose of this video is to put both these things in practice. A, how you can implement this equation, and secondly, how you should go about thinking about an investment's incremental cash flows. So consider the following example. Let's suppose you've been hired as a consultant for Good Day Tires. It's a manufacturer of car tires. The company has recently developed a new tire called the Mega Tread, and it is contemplating whether or not to make the investment which is necessary to produce and market it. Okay? Now, the production facility would be established on a piece of land that Good Day Tires already owns. So this is an important point. Okay? They already own the land on which they're going to manufacture the new tire, if they choose to do so. The company bought this land 3 years ago for $1.54 million. Okay, so this is how much they bought the land for, right? But this was 3 years ago. Today, there's been appraisal done on the land, and the company believes it could sell the land for $1.75 million on an after-tax basis. So if they sold it after taxes, they could technically get $1.7 million. This is an important point. When we think about estimating an investment's cash flows, I've talked about how you should always think about incremental cash flows. And so even though this company owns this piece of land, if they decided to pursue developing the new tire on this piece of land, one might say, oh, there's no cost. We already own this land. But there is. The cost is in terms of opportunity cost, right? So if you decided to invest in this production facility on this land, you would not be able to sell this land, and therefore there's an opportunity cost of $1.75 million on an after-tax basis. So this is the main point here, is that there's an opportunity cost associated with you starting this production facility on this piece of land. So keep this in mind as we navigate through the calculations. The question further says that in 4 years, this land could be sold for $1.625 million after taxes. And then it further says that the company also hired a marketing firm to analyze the market for Mega Tread, which is the new tire, at a cost of $210,000. This is market research that the company got done in order to understand whether it is worthwhile starting the Mega Tread project, if you will. Again, please keep in mind that this is money that has already been spent. Okay, so $210,000 has already been spent. And now the company has decided, based on the results from this market research, that, okay, we should go ahead with this project. But we should not account for this $210,000 as part of the costs associated with the new production facility that we're going to set up. Why? Because this market research cost is sunk. Whether we start the facility, whether we don't start it, we're not going to recover this $210,000. So keep in mind that this is sunk cost. Okay? And in a previous video, I've talked to you about how sunk costs are not incremental to projects, and therefore we should not account for them when evaluating investments. So when we're going to do our math, we're not going to count this as part of the cost. On the other hand, we will account for the $1.75 million as the opportunity cost associated with the project. So keep this in mind. The question further says that the company anticipates it will be able to sell 7280, 8240, 9455, and 62770 tires in each of the next 4 years. So we're given some anticipated sales over the next 4 years at a premium price of $365 per tire. So you're given an indication of how much you'll be able to sell each tire for. The project will be discontinued after 4 years. So maybe, there's this new trend going on, the Mega Tread, and maybe the company feels that after 4 years, it's best to discontinue this project and maybe start with another type of tire. So for whatever reason, after 4 years, we will be done with this project. Now, we're also given some information on the fixed costs for the project, $465,000 per year. Variable costs are going to be 20% of sales. And by that, we mean sales revenue. So however much we're going to generate in terms of revenue from this project. The equipment necessary for production will cost $4.25 million. So this looks like our capital expenditure, so CapEx, right? So this is the money that we're going to spend on equipment. We will depreciate it based on a 3 years maker's schedule. This is modified accelerated cost recovery system. This is a specific way in which certain types of machineries or equipments are depreciated for taxation purposes. There's a whole schedule that is laid out by IRS in which different types of equipment fall in 3-year, 5-year, 7-year, 10-year maker schedule. I will show that to you in a bit. Main point is that this maker schedule dictates how we will be recording depreciation for this project. And at the end of the project, the equipment will be or can be scrapped for $480,000. So this is what is typically referred to as the salvage value. Salvage value of the project. This is what we can sell the asset for. Please keep in mind that even though we can sell the asset for this much, it is not necessary that we will get this entire amount in our pocket. The reason is that whenever we sell an asset for more than what is its book value, then we can be liable to pay taxes or capital gains tax. And so there's a difference between salvage value and after-tax salvage value. I've talked about this in a separate video, but we're going to account for that in our calculations. And then finally, net working capital of $310,000 will be required immediately. You can think about this as upfront investment, maybe in inventory or something like that. So that's additional cash outflow happening. And Good Day Tires has a tax rate of 22%. Required return on the project is given, 12%. We are asked, what is the net present value of the project? Remember that in order to calculate NPV, we need two things. A, the cash flows that we're going to get from the project, and B, the discount rate or the required rate of return. The required return is given. What we need to do is estimate how much cash flow or free cash flow that we're going to generate as a result of this project. Once we do that, we can discount it at our 12% and get the NPV. Now recall that the financial cash flows of an investment can be calculated as earnings before interest and taxes into 1 minus the tax rate. You add depreciation to it, and then you subtract any capital expenditures, and you also subtract any changes in net working capital. So in a previous video, I've sort of talked about the motivation behind this particular equation. What we're going to be doing is really implementing this equation in the context of this question and figure out, what are the financial cash flows that this investment or project is going to yield at time period 0, which is today, time period 1, time period 2, and time period 3. Why 3 years? Because the question specifies, 4 years. 4 years. Why 4 years? Because the project is going to last for 4 years, and after that, we're going to be done. Now, to do this, I'm going to do two things. First, for convenience purposes, I'm going to write down all the inputs or all the numbers that are given to me separately. So that is exactly what I'm doing over here. I've written down all the numbers that are given, like capital expenditure, $4.25 million. So I've written that down. The useful life, the project is going to last for 4 years, but the useful life is 3. Why? Because it's going to be depreciated based on a 3-year maker schedule. So all the other numbers like the salvage value, the net working capital investment, the value of the land today and what it's going to be in 4 years, all the stuff that is given in this question, I've written it down separately. Why? Because then I can calculate cash flows by self-referencing numbers over here. And so that is what I am doing here. What I've done is that I've laid out the years. Year 0 is today. Year 1, 2, 3, and 4 represent the 4 years over which we're going to be generating cash flow from this investment. And what I'm going to do is just walk you through the numbers that I have over here. So for example, sales in the first year. So first of all, notice that Today, which is year 0, is the year in which you're making investments. So if you were to draw sort of a timeline, year 0 sort of represents, when you're setting up the equipment, when you're setting up your facility and all of that. So the first time that you're actually going to generate revenue from your operations or sales is basically when you've gone through the first year. So the first time that you actually record sales is for the first year, or whatever you incur during the first year, and then during the second, and then during the third, and then during the fourth. And so that is why you don't have any sales today, but you will have them at the end of the first year, and then second, third, and fourth. How much revenue are you expecting to make through sales? Well, if you look at this cell referencing the way I've done here, basically in year 1 we were told that we're looking to sell 7,280 units, and we were also told that each unit is going to sell for 365. So the sales revenue is simply 365 multiplied by how much we're looking to sell. And likewise, in the second year, we're going to have what we're looking to sell in the second year times price. In the third year, how much we're looking to sell in year 3 times the price, so on and so forth. So this is all the sales revenue that we're going to generate over the 4-year life of the investment. Then we were also told that there are fixed costs. Fixed costs were given right here, 465,000. These are fixed, so they don't change with output. So they have a constant 465, and then variable costs, we were told, were going to be 20% of sales. So all that I've done here is 20%, take 20% of whatever number is over here, and then 20% of whatever number is here, and that gives me the variable costs. So now comes depreciation, and what did we know? We know that depreciation is going to be based off of a 3-year maker's schedule, right? And so for that, we need to know what the 3-year maker's schedule looks like. And so if I scroll below, I have that outlined over here. Again, you don't need to memorize this. Is for questions like these. You often have this available if you're trying to solve a problem, or you can download it from the RSS website as well. The 3-year maker schedule says that if you have a machinery that is going to be depreciated based on a 3-year life, useful life, that in the first year you should depreciate 33% of it, then 44% of it in the second year, 14% in the third, and about 7.4% in the fourth. So these are percentages of the original cost of the machinery that you should depreciate. So all that I'm doing here, and again, ignore some of the calculations down here below for the time being, but all that I'm doing here then is saying, okay, what is the cost of the machinery? The total capital expenditure that you did was 4.25 million. In the first year, basically take 33% off that, and that is your depreciation expense. In the second year, take 44.45% of that number and use that as the depreciation. In the third year, 14.81%, and finally in the fourth year, depreciation is merely going to be 7.41%. So that's how the depreciation expense works. And now, based on these numbers, you can calculate your earnings before interest and taxes. So earnings before interest and taxes, and this, by the way, is also known as an investment's operating income, because that's exactly what it is. It is the income that you're kind of generating from operations. It is merely whatever sales revenue is minus all these different costs, including depreciation, which, recall, is a non-cash expense. After that, you can calculate taxes. This is a fairly straightforward calculation. Tax rate is given as 22%. So all that I'm doing is calculating taxes as 22% of this number to get what percentage of my operating income I'm going to be left with after taxes. So operating income minus the taxes gives me EBIT into 1 minus the tax rate. In other words, if taxes are 22%, then only 78% of EBIT is basically what I'm going to have after taxes. And in order to get operating cash flow, remember that I have to add back depreciation to this number. So that's exactly what I'm doing. I'm taking this number and then adding back depreciation. Why? Again, remember, depreciation is a non-cash expense and it needs to be added back. So this gives me my operating cash flow that I'm going to generate from this project over its 4-year life. We are not done because we still need to account for two other things, at least. One is the capital expenditure, right? As I showed you in the financial cash flow equation, we have to account for capital expenditures and we have to subtract them. So $4.25 million is what you're looking to spend today at time period 0. So that is your capital expenditure, right? That's right here. It is in fact this capital expenditure that results in all these tax deductible depreciation expenses for the next 4 years also. But the money gets spent here, $4.25 million. At the end of 4 years, and this is a very, very important point, we were told that you will be able to sell this asset for $480,000. Now, that represents an inflow. So the key point here is that we're not going to get the full $480,000. Why? Because the way the asset is being depreciated over its 4-year life, it's going to be depreciated fully down to 0. In other words, on your books, the value of the asset or the book value of the asset is going to be 0. And the way that works is this, and this is the calculation that I've done right here. This calculation is essentially showing you the accumulated depreciation of the machine over time, and therefore what is the book value. So for example, by the end of the first year, it has depreciated by 1.416 million. So I'm saying, okay, by the end of the first year, what is the total depreciation? Well, by the end of the fourth year, total depreciation is the same as how much it's depreciated here. This means that on the books now, the asset is simply worth whatever you bought it for, which was the 4.25 million, minus however much it has depreciated by that time, which is 1.416 million. By the end of the second year, it has depreciated even more, an additional 1.889 million. So if somebody asks you what is the accumulated depreciation, how much has the machine depreciated in total, you'd say it is however much it had depreciated the year before plus however much it is depreciated in the second year, right? So this is what I'm doing. I'm taking the first year depreciation and then adding the second year. So the accumulated depreciation is this much, which means that on the books, the asset is now worth even less. It's worth whatever you bought it for, 4.25, minus the total depreciation. And then in the third year, accumulated depreciation is whatever the total depreciation was in the second year, plus however much happened in the third. The book value is even lower. And notice, given the maker's schedule, by the end of the fourth year, the asset is depreciated fully, and therefore the book value, and this is the point that I was trying to make, the book value of the asset is now 0. So this is an asset that on your books is worth 0. So what happens is that when you go out there and sell something, sell the asset for something like $480,000, and really the asset is worth only $0 on your books, IRS says, hey, you're basically making a capital gains. You're making a profit, so to speak, and so you need to pay us tax on that. So you have to pay us 22% tax on the difference between what you are selling the asset for, which is $480,000, which is the salvage value, and what is the worth of the asset on the books, which is 0. And so, therefore, as you can see, you're not going to get full $480,000. You're going to get something less. And that is the math that I'm doing right here. I basically took 480, that's cell N4, okay, $480,000, which is basically, right here, the salvage value. And then I am deducting taxes on the difference between the salvage value and the book. So that's $374,400. You might be wondering why I have this as a negative number. The reason is that I am going to be, when I'm going to be calculating financial cash flows, I'm going to be taking my operating cash flow and then subtracting any investments that I'm making in capital expenditures and any investments I'm going to be making in net working capital. So whenever I'm spending money on machineries, that's money going out. So I'm subtracting that. So for example, I'm going to be subtracting this 4.25, but this is money coming in. So I'm multiplying this by -1 to make sure that this is a negative. Why? Because when I'm going to subtract a negative number, it's going to add to my cash flow. So this is my way of recognizing that this is actually money coming into the firm and not out. So that's why I have this as a negative. The other important thing here is that the value of the land, even though we own the land, the fact of the matter is that at time period 0, when you're committing that piece of land, there's an opportunity cost associated with it. So essentially, it's like you foregoing $1.75 million, which is the appraised value of the land today. And in 4 years, that land is going to become free again, and you technically will be able to sell it again. But you won't be able to sell it at the same price. So you're interested in knowing, okay, what will be the worth of that land in 4 years, since we know that it's expected to be 1.625 million. So that is what's technically coming in into the firm. And because that's the cash inflow, again, for the same reasons as I had this as a negative, I'm going to have this as a negative as well. Finally, the question talks about net working capital. It says that net working capital of $310,000 will be required immediately. So this means that at time period 0, we're going to have to spend $310,000. It seems like you will always, whether it's year 0, year 1, year 2, year 3, you will always have $310,000 tied up in net working capital. So net working capital, at least in this question, doesn't seem to be going up or down in subsequent years. In the 4th year, however, net working capital has to go down to 0. Why? Because investment in net working capital only is there to help you continue with your operations in subsequent years. Because you're not going to continue with the project from year 4 onwards, this means that any investment in net working capital that you've done previously, that will all get freed up. So net working capital will go down to 0. Okay, so this is why this is blank. So now we're not interested in net working capital per se. What we really care about is change or delta in net working capital. And so in the first, at time period 0 today, all of a sudden your net working capital will shoot up from 0 to 310. But in subsequent years, you're maintaining at 310, so there is no change. So notice I'm looking at the change. What was net working capital in year 1 minus what it was in year 0? Well, there's no change. No change here as well. No change here as well. But in the 4th year, your net working capital is going to go down to 0. So this means that the change is going to be negative 310,000. In other words, all the money that you had tied up, that is going to go down to 0, which means that all that cash is going to get freed up. So just like 310,000 is what you would subtract here, here you want to subtract negative 310,000, again in recognition of the fact that technically this represents money coming in. And so now you have all the ingredients to calculate free cash flow. Free cash flow or financial cash flow is always calculated as operating cash flow minus capital expenditures minus changes in net working capital. The only caveat here is that in addition to capital expenditures, there's also this cost that you're paying in terms of opportunity cost of the land. And so I'm subtracting that here as well. So in year 0, you're making essentially a cash flow. You're investing essentially cash flow of about 6.3 million. In the first year, the same equation tells you that you're going to get about 1.6 million from operating cash flow, no additional investments, no additional changes in net working capital. And then the last year, and this is critical, notice that you're going to get money from operations, but then you will also get money from selling your fixed assets. Your land is going to get freed up and you're going to recover money from that. And all the cash that was tied up in net working capital, that is going to get freed up. So in the last year, you make a lot more money than in the middle. And so now it's just a matter of calculating the NPV. And this is the NPV formula in which you use the required rate of return of 12%, discount all the cash flows, and figure out the NPV. If you're new to Excel and don't understand how this NPV is calculated, I have a separate video in which I explain this NPV formula, so you can take a look at that. But this, based on these numbers, is a good investment in the sense that the investment has a positive NPV. The main goal of this exercise was to help you appreciate how you can calculate financial cash flows as the sum of operating cash flow, capital expenditures, and changes in net working capital, and also to help you appreciate that we need to account for costs like opportunity costs. B, there are some costs that we did not recognize. We did not account for the market research costs here. Okay, we were told that market research was done for $210,000. We did not account for that because that cost is sunk. So this example is also useful in understanding what costs are incremental and which are not, and how they factor into our financial cash flow calculation and therefore into our capital budgeting decisions.